Hello and welcome. You're watching yet another episode of All About Your Company with me, Snehi Shah. And today we have a very interesting company in focus. One of the biggest players when it comes to the value retail space. We have V2 Retail, Value and Variety. That's V2 Retail that's joining us on the show right now. Now, before we tell you everything you need to know about this company, let's try and understand what we're trying to get out of this conversation. First, I want to understand what has led to the positive same-store sales growth for the company in the quarter gone by, in quarter 3, given the Durga Puja shift and all of its peers, almost all of them reporting negative SSSG. We just want to try and understand what has worked for the company and if that is sustainable going ahead. Next up, what is their outlook on Triple SG and their expansion plans? Are they on track to become a national level retailer in the next 1.5 years, which is something that they had guided about 6 months ago in September of last year? Are they on course to log that 8 to 10% same-store sales growth for FY26 as guided earlier? And if so, and because they have been doing so well, why not hike the FY27 same-store sales growth higher than 8 to 10%? On similar front, EBITDA margin guidance of 8%, while they have been logging EBITDA margins of 12% and 18% in the last 2 financial quarters of this year, why not hike that further as well? What's stopping them from doing that? This is something that we are going to try and gauge out of this conversation. Next up, they very recently concluded their QIP of about 400 crore rupees. How will the QIP proceeds will be allocated? What is the debt reduction plan? How much of that goes for store expansion versus debt reduction? All of this is something that we aim to understand. What is the downside risk to their guidance is, remember, not very long ago, they have hiked their store addition guidance. We'll be talking about that. And more importantly, what is the salience of newer stores as well? Now let's shift focus and talk about everything that you need to know about the company. Now, V2 Retail was originally incorporated on 23rd July 2001 as Vishal Retail Private Limited. Then they underwent the process of becoming a public limited company, thereafter which the company's name got changed to Vishal Retail Limited. On 29 July 2011, the company's name was changed yet again to V2 Retail, which is as we know it now. It's one of the fastest growing retailing groups in India. They deal in apparel, non-apparel, FMCG. They sell ready-made apparels, household items, footwear, watches, toys, toiletries, grocery items, sports items, crockery, novelties and gifts. So that product portfolio that they offer in the value retail category is very vast. Let's talk about their store network. As on 31st December 2025, that's the end of quarter 3 FY26, their store count was at 294 stores. This is spread across 225 cities with presence in 25 states. And if you talk about their quarter 3 latest store addition number, they've opened 35 stores in quarter 3. Just trying to understand how their operations are split geographically. They have high presence in Uttar Pradesh, Bihar and Odisha. Growing markets for them are Assam, West Bengal and Punjab, among others. Emerging presence in Uttarakhand, Jammu and Kashmir and Rajasthan. And they're trying to develop a footprint in Andhra Pradesh, Chhattisgarh and Himachal Pradesh, among others. So quite widespread is what their operations look like right now, at least when it comes to the India geography. Now let's talk about their operational metrics. The number of stores that they have opened has consistently gone up, with the recent spike being of 43 stores in quarter 2. So that number will be up for you. That's the trajectory at which they have been opening stores. What is very interesting is that they had guided for 100 stores to be opened at the start of FY26, and not very long ago they hiked that number to 130. Out of which 106 stores they have already opened as of quarter 3 end. 24 are yet to go, from which we understand that some more store openings have happened in this current quarter, that's quarter 4. The next year's target has also been increased from 120 to 150 stores. So we'll try and understand what's driving this confidence and if they're on track to doing so. Now, more importantly, for any retail company, any value retail company, here are some metrics that we have been tagging. That is the store number of stores trend. You have the store count trend in terms of what is the growth. That's the number that we're looking like. More importantly, I want to analyze the same store sales growth number. Now, this number indicates per store what is the growth and what is the overall contribution to the overall pie. Basically, this is the store level growth number that we are looking at. In FY23, this number was at 651. In FY24, 854. So quite the hike over there. This is the sales per square feet I'm talking about. Let's talk about SSSG. 31% in FY23, 31 in FY24, 29 in FY25. Not so much of a variance. Now, if you take a look at the quarterly numbers for quarter 1 FY26, the number was at 5% with normalized growth at 10%. This is in account of the shift in Eid dates. For quarter 2 FY26, growth was at 23.4%, normalized growth at 10.3%, taking into account the fact that Durga Puja shifted from quarter 3 to quarter 2 and in quarter 3 FY26. On the back of this Durga Puja shift, you had a lot of companies, a lot of peers of this company that reported negative SSSG, but you had V2 Retail that managed to report a 2% same-store sales growth with a normalized number at 12.8. So still looking healthy when you compare it to peers. The sales per square foot has been a consistent growing trend. Average selling price has also gone up. Average billing value is an interesting metric to look at. Very consistent growth over there. Slight dip in quarter 2. That's when the GST impact was announced on products under a certain price range, but almost all of their products fall below that value category, below that 1,000 rupee mark, which is why they have done so well. And in quarter 3, this number was at 964. Now let's refocus, look at the financials, talk about the profit and loss of the company. If you take a look at what these metrics are, revenue growth has been quite consistent with a 3-year CAGR coming in at 44%, very healthy growth coming in. You have EBITDA that has grown at a CAGR of 57% over the last 3 years. Margins have been very solid and very sturdy if you talk about that. The net profit number, they had a net loss in FY22, in FY23, but they've turned that around completely in FY24 and 25. The numbers on this front are also looking very good. Specifically talking about quarter 3, FY26, that's the most recent quarter that went by. Margins were at 18.7%. They did have an exceptional gain of about 28 crore rupees, but other than that, the numbers were very healthy. They also very recently announced a stock split in the ratio 1:8, the ballot process of which has just been concluded. Let's understand the 9-month move of the company now. In terms of financials, you have seen a growth of about 64% in revenue, 74% in EBITDA if you compare 9 months of this financial year compared to the 9 months of FY25. The margins have stayed rather stable, so there is nothing actually to worry about when it comes to that number. But the net profit, the kind of surge we've seen, more than double from 65 crores to 144 crores, is the kind of move that we're seeing when it comes to the 9-month financial. Now, since we've spoken about how healthy the margins look, here's a trend of how the margins have shaped up in the last few quarters and financial years. What started at 10.7 in FY22 inched up all the way higher to 13.8 in FY25 and is at 18.7 in quarter 3 FY26. So what's working out so well for the company is something that we aim to understand as well. Now let's talk about the balance sheet of the company. The equity is constant at 35 crore rupees. Their other equity, that's profit plus reserves, consistently rising. So very healthy number over here of 352 crore rupees. Book value also looking very, very healthy at 387 crore rupees. Now something to watch out for is the borrowing, the debt of the company. This is also something, along with very good metrics, this is also something that has seen a rise. So I would slightly be concerned at this number that they have here, 168 crore rupees. So what we want to understand from the conversation with the management is how much of the QIP fundraise is going to be allocated towards reducing debt and what is the resultant debt going to look like. Let's talk about the cash in bank. What they have in the bank right now looks healthy at about 15 crore rupees as well. Shifting focus, let's talk about the cash flow of the company. The cash flow from operations, steady compounder over there as well, 223 crore rupees in FY25. EBITDA looking healthy at 260 crore rupees. And what's very interesting is their cash flow to from operations to EBITDA ratio. How much of their cash flow is actually trickling in and forming the part of their EBITDA is also looking very healthy at 86%. It took a dip of about 62% in FY24, but has come back at 86%. So this is a very healthy number. Net cash flows, they're currently at 0. So all of that is being absorbed in the company. We'll try and understand more about that as well. Return ratio is also looking very healthy. Consistent hike in the ROCE of the company all the way from 4% in FY22 to 17% in FY25. So all in all, very healthy growth coming in for the company. Shareholding looking solid. Promoters have continued to maintain their stake at 54% before very recently trimming it down to 51%. FIs are looking good. You had some exits coming in and some entries again. DIs look solid with a 9% stake. Public in number of shareholders shareholders, this is what you have on your screen right now. Very quickly, lastly, let's talk about what the valuations are. 1 year forward, price to earnings, this stock trades at about 25 times. The 2-year range is anywhere between 24 times and 57 times given the rate at which the company is growing. They've also guided for 50% revenue growth for the next few financial years. So on the basis of that, there is a broad range, which brings their 2-year average to 36.3 times. If you stack it up with their peers, this is the most cheap stock right now in this value retail basket. V2 Retail at 25 and the highest is V-Mart at 118. Lastly, if you talk about the analyst recommendation, the one analyst that covers this stock has a buy rating on the stock with a return potential of 64%. With that, that's everything you need to know about the company. And as we slip into a very short break, we'll come back on the other side and get into conversation with Mr. Akash Agarwal of the company to try and understand everything and a little bit more about what we've spoken. So be right back and slipping into a very short break. Welcome back to All About Your Company. The company that we were discussing today is V2 Retail. We've gone through the financials, we've gone through the balance sheet, and you know everything you need to know about the company in terms of numbers. But let's hear in from the management themselves. We have Mr. Akash Agarwal, the whole-time director at V2 Retail, joining us on the show. Akash, hi, good afternoon, and thank you so much for your time. You know, let's start by talking about your latest performance in Q3, and I have to say it was nothing short of stellar, given that it's been a difficult quarter for the entire industry on the back of Durga Puja shifting from Q3 to Q2. Talk to us about what worked out for the company. How were you able to log in that positive 2% same-store sales growth? I know the normalized number is much higher, but just help us understand what was the strategy and what worked out.
So I would say the two most important things would be our strong product development and our focus on affordability. And both of those things together, combined with a very robust supply chain and a very strong backend, has really helped us, ramp up our new stores faster than ever, and as well as get a very strong SSSG in the old stores as well.
Okay, so that's something that's working out for you. But Akash, talk to us about the SSSG guidance. You have been growing consistently. Of course, 1 or 2 blips here on account of festive periods shifting. But other than that, the SSSG growth has been robust. Why restrict this guidance to about 8 to 10%? What's the logic here? Why not hike it going ahead?
So you need to understand that over the last 3 years, we have moved from an average sales per square feet of 650 to more than 1,000 rupees. So the base for the old stores have completely changed. And if you just look at old stores in isolation, their per square feet sale is almost 1150 to 1200 rupees. So getting an 8 to 10% SSSG on 1200 versus getting a 20% SSSG on a base of 650. So that's why, in percentage terms, we are targeting 8 to 10%.
Okay, understood. Let's talk about the revenue guidance that you have shared with the street. 50% revenue growth is something that you're aiming for in the next financial years. This is for every year that you are aiming for. Talk to us about what is going to be the key growth driver here, what is going to lead to this 50% revenue growth, how confident are you of achieving it?
So there are two growth drivers primarily here. So one is the same store sales growth of 8 to 10%. So that will be the organic growth. And another would be the 40 to 50% new area that we will open every year. And we feel that value fashion in India is still very underpenetrated. And we too, being a pioneer in this space and our focus on product development and affordability, I think we are poised and well positioned to grow sustainably at around 40 to 50% for the next 4-5 years.
Okay, so while that number is very encouraging, Akash, can you talk to us about any risks to this guidance? Anything that could maybe make you want to change the number? Any circumstances that you're foreseeing, perhaps?
So see, these numbers are completely conditional on the momentum being, only if the momentum continues and without compromising on any of the metrics, that is gross profit per square feet, the EBITDA margins, the new store sales per square feet, the SSSG numbers. So we're not chasing growth blindly. But what we're saying is if we stick to our plans, if we execute everything well and the momentum continues, then we will keep accelerating the store expansion.
Okay, that sounds optimistic. Akash, let's talk about the store expansion itself, since you mentioned it right now. Not very long ago, you've hiked the store expansion guidance for next year as well from 120 to 150. And more importantly, for FY26, for this financial year, you had guided for 100 stores in the beginning. Now that has been upped to 130. If I add the cumulative store openings that were done in the first 3 quarters of this financial year, you're already at 106, which means to achieve your guidance, you have 24 more stores to go. This was, of course, at the end of quarter 3. So far in quarter 4, talk to us about how many stores have been opened and how close or how away are you from this target of 130 stores?
So in quarter 4, we've already opened 20 more stores. And I think by the end of this month, we're going to open at least 7, 8 more stores. So we're going to actually beat the target. And for next year, again, we would open more than 150 stores now, considering the kind of performance that we're seeing. So hopefully, we would be able to open about 170 to 180 stores next year.
Okay, so that's yet another hike in your store addition guidance. Is that right, Akash? From 150 to 170 to 180. Confident about that?
Correct.
Okay, absolutely. Okay, so perfect. Let's talk about how these stores are going to be opened in terms of geographically, what is going to be the spread. You already have very high presence in UP, Bihar, Odisha. Talk to us about what is the spread going to be between growing markets, emerging presence and developing footprint in Andhra, Chhattisgarh, Himachal. What are going to be some priority geographies that you're going to be targeting?
So now we have a store in almost 25 states in India. So the trajectory or the target markets are completely decided by performance. To give you an example, we had entered Karnataka and West Bengal with a couple of stores just a couple of years back. But because the performance was so strong, now we have almost 20 stores in Karnataka and about 13, 14 stores in West Bengal. So similarly, we have entered a lot of new states this year, whether it's Rajasthan, Gujarat, Andhra Pradesh, Chhattisgarh. So we'll see the performance and then take the call. But historically, what we've seen is 60 to 65% of the new expansion will come in existing core markets, and about 35% will come from newer geographies where we get very strong performance from.
Okay, let's talk about the debt on the books, Akash. For first half of FY26, the number that we're looking at is about 168 crore rupees of debt. Now, the last time we interacted, you did say that about 100 crore rupees of the 400 crore rupee QIP is going to be allocated towards debt reduction. Is that a right estimate to look at right now?
Yes, so we paid off the debt when we raised the money through QIP. And now we use debt because we give a bill discounting facility to all our vendors. So they can avail any of the due bills within 1 or 2 days of supplying the goods, because we want to be their priority vendor and we want to help them with working capital needs. So because we wanted to utilize the QIP money over the next 12 months for capital investment, we use that money right now for working capital and doing prepayments for our vendors. But when we raised the QIP money, we were debt free.
Okay, so right now, what is the debt on the book? If you could give us the most latest update here.
I think it's around 70 crores.
Okay, and this is going to be paid off eventually, right?
Again, most of the money that will be utilized for working capital and prepayment and capital investments. So we are okay to have a debt to equity ratio till 0.5, but in the near future, it will be less than 100, 150 crores.
Okay, understood. And also talk to us about the market or the segment in which you are present, value retail. You did say that this is a category that's under-penetrated in India. Now we have a whole bunch of listed players for your space, and also Zudio is also a very up-and-coming player. They've been launching new categories, new sub-brands. Talk to us about what is the competitive landscape looking like and what are the moats for growth for V2, what's driving the confidence?
So if you look at just organized retail in this price segment, I would say it's less than 30% of the total retail market. That's why we say underpenetrated. And when you speak about Zudio, it's a different price segment. Their ASPs are much higher than ours. Similarly, Reliance Trends, Pantaloons, they are at a different price level. So we operate at an ASP of around 300 rupees. So I think in every price segment, India is a big enough market to have 4, 5 strong players national level players with multiple hundred stores.
And that brings me to my next question, Akash, because I remember in September you had told us that you aim to become a national level retailer in 2 years. It's been 6 months since that conversation. What has been the progress here, and are you on the timeline that you had set for yourself?
So yes, we did enter 7 new states this year. We are on track for that trajectory, and we should have multiple stores in most of the states at the end of the second year.
Okay, so that sounds good. From what I understand, if you talk about your product portfolio and your average billing value, that is still under 1,000 rupees. Now, the GST cut has been beneficial to you to some extent, but since most of your products were under that bracket, I understand that there has not been much of a push coming in. Talk to us about if you have any number in mind for how you want to be driving up this average sales value or average sales price or average bill value. Any of these metrics, are you looking at just organic growth, or are you working with a fixed number?
So we are not actually looking to raise our ASPs. I think that will move with inflation. And average bill value increased, I think, because we removed a lot of entry price points and table items where we could not provide a differentiated product or where we had to provide a substandard fabric. So we completely changed our assortment in a way where, we completely remove the head and the tail of every category. So that, and because we've introduced new categories like slippers, footwear, beauty, so that all of them together helped us increase our average bill value. But going forward, also, most of our growth or the SSSG that we target, it's from getting additional customers and getting more market share in the space.
Okay, so that is the growth strategy, and that is everything you needed to know about V2 Retail. Akash, really appreciate you taking the time out and joining us on the show. Good luck on your guidance ahead. 8 to 10% same-store sales growth is what they're guiding. 50% revenue growth for the next 4 to 5 years, and more importantly, what's really important to know is that they have hiked their guidance for FY27 in terms of store count from 150 to now 170 to 180. So that's a very big takeaway from this conversation. But with that, we're completely timed out on this edition of All About Your Company. It's a wrap on the show. Thanks so much for tuning in.